Foreclosures are ticking up, mortgage rates are just stuck, and in some cities, we're seeing price drops that are giving everyone some serious 2008 flashbacks. So the big question, the one we're all asking is the U.S. housing market about to drag the entire economy down with it?
You know, it's the ghost that haunts every single housing headline, right? You see inventory starting to rise, you feel that stress in the market, and your brain just immediately jumps back to the great financial crisis. But is that comparison even fair? Are we really on the brink of another total collapse?
Okay, so the short answer, if you're just looking at the hard data, is a pretty firm no. What we're actually going through in 2025 is what we'd call a housing correction, not a crash. And believe me, the difference between those two words is absolutely massive. So in this explainer, we're going to break down exactly why this time really is different.
All right, let's dive into the evidence. To really get why this isn't a repeat of 2008, we've got to, define our terms and look at the key indicators that all the experts are tracking right this minute.
Okay, words really, really matter here. A crash, think 2008, is a super fast, super severe, double-digit price drop. It's a free fall. But a correction, and this is what we're seeing, is a much less severe dip, usually under 10%. It's basically the market just cooling its jets after being way too hot. And all the data points to us being in a correction, not some catastrophic crash.
Now look, that doesn't mean there aren't some warning signs flashing. There absolutely are. The foreclosure rate has ticked up to just under 0.5%. Housing inventory, it's up a whopping 26% from last year. And get this, nearly 1 in 5 listings has had a price cut. So yeah, you can see why people are getting a little nervous. But it's the context around these numbers that is just so crucial.
And the single biggest driver of all this stress, it's this number right here, 6.5%. The 30-year fixed mortgage rate is just stubbornly hanging out around there. I mean, after years of ridiculously low rates, this is a massive shock to affordability. It's basically putting a chokehold on the market for anyone trying to buy a house.
So here's something that trips a lot of people up. You hear the Fed is cutting its main interest rate, so you think, great, mortgage rate should be dropping too, right? Well, not exactly. Mortgage rates don't really listen to the Fed directly. They tend to follow the 10-year Treasury yield and just general fears about inflation. And right now, those things are keeping borrowing costs painfully high for homebuyers.
And this brings us right to the heart of the matter. To really, truly understand what's happening in 2025, we have to put it up against the ultimate benchmark for housing disasters, 2008. So let's look at the key differences, side by side.
Man, this chart really says it all, doesn't it? Back in 2008, the whole crisis was built on a house of cards. Risky, subprime lending to anyone with a pulse. Today, lending standards are super strict. Back then, the market was drowning in over 4 million homes for sale. Today, we've got just over 1 million. So you see, it's a completely different kind of problem. It's not a financial system on the verge of collapse. It's a crisis of affordability and access.
And if you take away just one thing, let it be this. The single biggest factor preventing a total price crash is a chronic, long-term undersupply of housing. For more than a decade, we just haven't built enough homes to keep up with the number of people who need them. This massive supply shortage is acting like a powerful safety net, a floor under prices, stopping the kind of freefall we saw back in '08.
And hey, don't just take my word for it. The experts agree. JP Morgan isn't forecasting a crash at all. In fact, they're predicting modest price growth of around 3% for 2025. That's the sign of a market that's normalizing, it's stabilizing, not imploding. It feels more like a return to a healthier, more sustainable pace, you know?
Okay, so a 2008-style crash is off the table, which is great news. But even a housing correction sends ripples out across the entire economy. So the next question is, who is most at risk?
Well, when home sales slow down, some sectors feel the pain almost immediately. Think about it. Construction and building materials, mortgage finance companies, and even home improvement stores like Home Depot or Lowe's, they all take a hit. But the ones we really have to watch closely are the regional banks, because they're often heavily exposed to all kinds of real estate loans.
But, beyond the corporate balance sheets, the real squeeze is felt by actual people. This isn't a crisis for Wall Street this time. It's a crisis for Main Street. First-time buyers are totally locked out by these high prices and rates. Middle-class families who got a great low rate a few years ago, they're basically trapped. They can't afford to move. And renters? They're facing ever-rising costs as the dream of owning a home just gets further and further away.
And there's this other crisis kind of simmering in the background that could spill over and make things worse: commercial real estate. Office vacancy rates have hit a jaw-dropping 20.4%. I mean, 1 in 5 offices is empty. The loans backing these empty buildings are a huge source of stress for those exact same regional banks we were just talking about. This is a hidden threat that could definitely add some fuel to the fire.
So, with this really complex picture in mind, how are you supposed to navigate the road ahead? What are the key things you should be focusing on, whether you're trying to buy, thinking of selling, or maybe just watching from the sidelines? All right, let's break it down. For potential buyers, the name of the game is all about strengthening your finances. Focus on boosting your income and saving up for a bigger down payment. For current homeowners who are sitting on a sweet, low mortgage rate, you got to think twice before selling. Seriously, run the numbers. The cost of moving to a new house at today's rates could be absolutely astronomical. And for investors, the focus really needs to shift to properties that are going to generate positive cash flow right from day one.
And hey, if you want to track this stuff yourself, here's a little dashboard for you. Watch the spread between mortgage rates and treasury yields. That tells you a lot about the risk in the system. Keep an eye on the inventory to sales ratio to see if supply is finally catching up to demand, and definitely monitor those price to income ratios and migration patterns to see which local markets are getting hotter or colder.
So let's just sum it all up. The 2025 housing market is not a repeat of the 2008 disaster. The foundations today are way stronger and the whole dynamic is completely different. But let's be super clear, this is not a normal, healthy market either. We are in some strange, uncharted territory, stuck between high prices, high rates, and super low supply.
And look, that's the big national picture. But as they always say, all real estate is local, right? The data can tell one story, but your neighborhood might be telling a totally different one. So what are you seeing on the ground in your city? I really want to know. Drop a comment below and tell us. And for more explainers just like this one, make sure you're subscribed.